Welcome back to Turn the Task Consulting Group, Sunday Night Live. We used to say live at 5, but we go live in the evenings whenever we get on it these days. So we're live. It's not quite 5. It's 6:36. We got a lot going on here, but glad to be with you all the same because, you know why we're here. We're here to help you and the people you love get to and through college, university, or the trade schools earlier on time with minimum to no debt. And, we went there last broadcast. We went there and we talked about taking the red pill, right? So we wanted folks to take the red pill and understand some truth about what's going on with big higher education. And understand that when I talk about these things, I'm not just hypothesizing. I'm not prognosticating. I know this stuff. I know it. I formally entered the realm of higher education as a first generation traditional aged student in the 1990s. I won't say when because I don't want to further or exactly date myself. But all that to say, I got into there as a traditional age student in the 90s and then left college because I ran out of money. I did everything wrong. I left my home state. I ran out of money, went to default, owed the college money, blah, blah. I didn't get back to college until 10 years later. And by then I was married and, looking at having children and, just trying to get things figured out before life got away from me. And, fortunately, we were able to get it done. I mean, I got the bachelor's degree done literally 2 weeks, not even like 10 days before my son was born. And, we'll go ahead and clap that up because, it was a real achievement. Trust and believe, we were very pregnant when I graduated from college with my bachelor's degree. And then went on and got the master's, and now I'm pursuing my doctorate. But the point is that I know what it is from a traditional age student, know what it is for a non-traditional working age parent, spouse, non-traditional working person. And then I got into the field properly as an employee, starting at the very bottom in admissions in 2005. And worked my way from entry-level admissions all the way up to the corner office in the vice presidency of student affairs and enrollment management. And I sat in so many different seats along the way. So when I talk about these things, I'm not just pulling it out of thin air. I know this stuff. I know it. I've lived it. I've breathed it. I have all of the T-shirts. Most of them no longer fit. Wrong one. There you go. Yeah, I got all the T-shirts. And so I can speak to these things with true wisdom, with true knowledge and lived experience. And that's the advantage that you get when you work with us here at T3CG, Turn the Tassel Consulting Group, because you're not just getting boilerplate information, you're getting the inside scoop and the inside information about things that actually impact you and can adversely harm you if you don't know what you're doing, which most of us don't know because most of us just follow the lemming trail and just go along with what everybody says you do, right? Everybody goes to college. Everybody goes to college. Whether or not that's still relevant or whether or not that's still something you should do, we just have that drummed into our minds. And so often we don't catch up to what is actually going on in society, sometimes for a decade or more before we realize, oh, that is no longer relevant. So I'm here to give the wake-up call and to really let you know that there are perils out here about higher education. And we're here to help steer you around it. So what I want to do is, for this evening's live broadcast, I want to help you to see what's coming. Now, I know I just said that I'm not a soothsayer. I don't have a crystal ball, what have you. I'm not, and I don't. But again, I've revolved on this planet around the sun enough times, and I've seen enough things happen to understand cycles and to understand routines. And so if you understand the past, then you can, with relative certainty, accurately predict the future. And so for this evening's live, I want to look at the housing crisis, which ultimately became the financial crisis of 2008. And I want to look at what happened with the housing market, because this is a prime example of how, and no pun intended, because a bunch of it was around subprime lending, but you know, put myself a little laugh track on that. No pun intended, but the subprime mortgage market, right, effectively crashed the economy. It was one sector of the economy, and it derailed the whole thing. And so if you understand how one sector of the economy can derail the whole thing, you can understand how the student loan crisis that we're dealing with today has the absolute, not just potential, not just capacity, has the strong likelihood of wrecking our economy. So we're going to look at that. To do so, we're going to look at a video that describes how it happened. And that's literally the title of the video. It's How It Happened, the 2008 Financial Crisis, Crash Course on Economics. All right, so we're going to go ahead without further ado and cut to camera number 2.
Welcome to Crash Course Economics. My name is Jacob Clifford.
And I'm Adrienne Hill. And today we're going to do something a little different. We're going to explore one moment in history in depth. We're going to talk about how the 2008 financial crisis happened and the government response to it in the United States.
So let's get started. The 2008 financial crisis was a big deal. Ben Bernanke said it could have resulted in a 1930-style global financial and economic meltdown with catastrophic implications. But what happened? Why did it happen? And why aren't we all huddled around burning trash cans, forming a raiding party to go steal gas from other tribes in the wasteland? By the way, if you're actually doing that, you probably didn't hear we survived the financial crisis. Things got better. Seriously, put down your crossbows.
To explain what happened, first we have to do a quick explainer about mortgages. And you might already know this, but basically someone that wants to buy a house will often borrow hundreds of thousands of dollars from a bank. In return, the bank gets a piece of paper called a mortgage. Every month, the homeowner has to pay back a portion of the principal plus interest to whomever holds the piece of paper. If they stop paying, that's called a default, and whomever holds that piece of paper gets the house. The reason I'm saying whomever holds the paper rather than the bank is because the bank, the original lender, often sells that mortgage to some third party. And the reason I say often is because this happens all the time. I've had my house for 9 months and 3 different banks have had the mortgage. Traditionally, it was pretty hard to get a mortgage if you had bad credit or didn't have a steady job. Lenders just didn't want to take the risk that you might default on your loan. But all that started to change in the 2000s. And before we go further, a quick aside here. The story gets complicated fast, and it's a fascinating story, but we're trying to keep it relatively simple. So I've asked Stan if we could put some additional resources in the YouTube description. And Stan said yes.
All right,
thanks, Stan.
Stop the show for a second. All right, let me just real quick. So a quick parallel to draw here to the student loan crisis that we're dealing with now. Remember, $1.73+ trillion of student loan debt in the country. She just made a point. She said that prior to the housing nightmare that they're about to unfurl, you really had to have good credit, and you had to have bankable, reliable income stream / collateral to be able to qualify for a mortgage and get a good rate to be able to buy a home. Okay, that was standard operating procedure. If you didn't have those things, then you didn't qualify for a home. You were a renter. Okay. And you've heard me often say on the show so many times that, where in any other venue financially can someone go and get a loan for 6 figures with no collateral, no credit in most cases, because we're talking about 17-year-olds, right? No immediate prospects for a job. There isn't one. The only venue you can do that in is with big higher education through the federal direct loan program. And it was all based on this idea that everyone should go to college. Okay. And not only should everyone go to college, but everyone should be able to go to their dream school, because that's really what it comes down to. It's not like you were restricted to certain kinds of colleges that you could go to if you use the direct loan programs, right? There were no restrictions. It was like, you should better go to whatever school you want to, whatever school you can get into, no matter how much it costs, you should be able to go there. So we're going to make it possible for you and your parents through a Parent Plus loan. Nightmare. Worst financial product in existence. Sorry. I defy anybody to prove otherwise. It's awful because of the timing. It's awful because high interest rates, the timing of when someone would take that loan out, right as they're literally staring retirement age down the barrel. You're going to take up 6-figure loans. Well, my kid's going to pay for it. They promise. Really? They're going to pay for it when we know, like, most of them aren't even going to graduate. Those that do graduate are going to graduate with some ridiculous underwater basket weaving degree that has no market value, cannot get them a good job. We know that most of them are now baristas at Starbucks. Yeah, that kid is going to repay your 6-figure student loan debt that you as a parent took out. Come on, people. All right, back to it.
Back to our story. In the 2000s, investors in the US and abroad looking for a low-risk, high-return investment started throwing their money at the US housing market. The thinking was they could get a better return from the interest rates homeowners paid on mortgages than they could by investing in things like US Treasury bonds, which were paying very, very low interest. But big money global investors didn't want to just buy up my mortgage and Stan's mortgage. It's too much hassle to deal with us as individuals. I mean, we're pains. Instead, they bought investments called mortgage-backed securities. Mortgage-backed securities are created when large financial institutions securitize mortgages. Basically, they buy up thousands of individual mortgages, bundle them together, and sell shares of that pool to investors. Investors gobbled these mortgage-backed securities up. Again,
Yes,
they paid
did.
a higher rate of return than investors could get in other places, and they looked like really safe bets. For one, home prices were going up and up. So lenders thought, worst case scenario, the borrower defaults on the mortgage, we can just sell the house for more money. At the same time, credit ratings agencies were telling investors these mortgage-backed securities were safe investments. They gave a lot of these mortgage-backed securities AAA ratings, the best of the best. And back when mortgages were only for borrowers with good credit, mortgage debt was a good investment. Anyway, investors were desperate to buy more and more and more of these securities. So lenders did their best to help create more of them. But to create more of them, they needed more mortgages. So lenders loosened their standards and made loans to people with low income and poor credit. You'll hear...
Stop the show. Okay, you see that? They needed more because, again, they wanted to make more money, bottom line, for their investors. What have I told you? This is a business. There are shareholders involved. And I don't want to hear the nonsense about the proprietaries, the University of Phoenixes of the world and the Strayers and it's no different. UPenn, Drexel, you can tell I was in Philly today. Villanova, Princeton, Brown, Stanford. It's a business. It's a business. And there are shareholders. Well, they're not really shareholders. Okay, don't split hairs. Come on. Don't do that. Don't split hairs. They are shareholders. They're called boosters, alumni, and properly shareholders if they're the proprietary schools. But it's the same thing. It's the same thing. There's no difference. Okay. So what did they do? They started opening it up for subprime lending. What's subprime lending? Giving loans to people who cannot afford to repay them. And Because they can't afford it. They never could. But we got to keep the shareholders happy. So let's make these loans to it, because there's the market's doing so great right now. We'll be just fine. And you know what? Even if they do default, all right, we'll just evict them from their homes and we'll put them on the street and then we'll sell their house. And we'll get more money that way because the value's gone up. Do you see how we've been monetized? They don't care about you or your son or daughter or other. They don't care that you're staring retirement down the face, down the barrel. They're going to tell you that it's a good idea for you to take out 6 figures of student loan debt as a parent as you get approaching retirement age. They're going to encourage you to do that, even though they know that it is not in your best interest. In fact, it's in your worst interest to do so. They know it's going to send most of you into bankruptcy. Most of you are going to end up in poverty as a direct result of that decision, for a degree that most of your students won't even acquire. And for those that do, and I've been through all the statistics, so go back to the library if you want to hear all that again. And for those who do actually graduate with the credential in the national average 6 years it takes on a 4-year degree, 3 out of 5 of them aren't even working in the career path that they studied in. And they're making way below what it would take to not only pay back the loans they have on their ledger that they borrowed, but how much more the loans that you borrowed on their behalf. That's based on your credit and tied to your Social Security number. They're not paying that back. They can't. And neither can you, which is why you shouldn't do that nonsense. All right, back to it.
Called subprime mortgages. Eventually, some institutions even started using what are called predatory lending practices to generate mortgages. They made loans without verifying income and offered absurd adjustable rate mortgages with payments people could afford at first, but quickly ballooned beyond their means. But these new subprime lending practices were brand new.
I'm sorry. I gotta stop the show. This is important, okay? That adjustable rate mortgage, the ARMs, they'll tell you need to break your arm. Yeah, you need to break that arm. They wouldn't even verify your income. They'd bring you in, give you a mortgage, and they'd set you up with these payments that were affordable at first. And then, bam, they'd hit you with the adjustable rate. That rate would go up, and now all of a sudden, bam, all that money you thought you were skating by on, they're making that up and then some with this giant jump in your monthly expenses. No one can afford that. Does that sound familiar to you? It should. Because if you've been watching this program, you know that one of the big things that gets touted right now is the student loan forgiveness program and the graduated scale plan and the, pay it off in 20 years. They've got all these different programs to assist you in affording these loans that you can't afford, right? And it's nothing more than an adjustable rate mortgage. It's the same thing. Well, we're going to give you an income-based repayment schedule. So if your income is 0, that means your payment for 10 years is $0. What? And after that 10 years, if you make 10 years of $0 payments every month on time or early, we will forgive the remaining balance. Well, guess what? That remaining balance is, it's capitalizing and interest is accruing and capitalizing and accruing and capitalizing and accruing. By the time that decade is over and you made your 0 per month payment, not only have you wasted a decade of your life because you made 0 money for a decade, and I'm using the most extreme example, obviously, this is a sweeping generalization to make the point. Okay, income-based repayment of 0 if you are unemployed for a decade, right? Now your $96,000 of student loan debts, and this doesn't include a Parent Plus, by the way. They're on their own because that's not, they got to pay that. But for your $96,000, all right, you got through a decade. Now they're going to forgive it. Here comes your 1099-G for income that you received in that current tax year, a decade after you get through that program. Now you've got a 1099-G after capitalization and interest accrual, blah, 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 of $250,000+ that was forgiven for you. So you went from making $0 a year for 10 years to $250,000 in the year that they forgave it. And guess what? You didn't pay a dime of taxes on that. And guess what else? Now you're in the 1%. You're in the top 1% because you made $250,000. You're in the top tier tax bracket. So now you're no longer obliged to the Department of Education, who can garnish your wages, who can garnish your income tax returns, yada, yada, yada. Now you're obligated to the IRS, who can do all of those things that the Department of Ed can do, and also throw you in jail. The student loan program through the Federal Department of Education, the direct lending program, is predatory lending, is subprime lending, is an absolute nightmare. Let's keep going.
Agencies could still point to historical data that indicated mortgage debt was a safe bet. But it wasn't. These investments were becoming less and less safe all the time. But investors trusted the ratings and kept pouring in their money. Traders also started selling an even riskier product called collateralized debt obligations, or CDOs. And again, some of these investments were given the highest credit ratings from the ratings agencies, even though many of them were made up of these incredibly risky loans. While the investors and traders and bankers were throwing money into the U.S. housing market, the price of homes in the U.S. was going up and up and up. The new lax lending requirements and low interest rates drove housing prices higher, which only made the mortgage-backed securities and CDOs seem like an even better investment. If the borrowers defaulted, the bank would still have this super valuable house, right? No, wrong. Let's go to the thought bubble. Actually, let's go to the housing bubble. You remember bubbles, right? Rapid price increases driven by irrational decisions. Well, this was a bubble, and bubbles have an annoying...
Rapid price increases driven by irrational decisions. You know what? I'm not even going to apologize. I'm going to stop and jump in when I need to because it's important. Okay? Irrational decisions driven by... Well, I guess that was the punchline. This thing is such a nightmare because this whole idea of everyone's got to go to college. It's irrational. It's also untrue. Not everyone needs to go to college. Some people are not right for college. They're just not. I defy you to tell me that everyone should go to college when some people are craftsmen and women and others. They're good with their hands. The idea of sitting at a desk and shuffling papers around is like a death sentence to some people, which is what most of the college degrees are going to prepare you to go do. It's not for everybody, okay? But this is a rational decision, right? Drove people in droves, pun intended, into college. And so we talked in a previous broadcast about how it's an inflated market, how it's a market that's being propped up. It's an antitrust market, higher education, big higher education, because the colleges are de facto colluding with each other to figure out what's going to be the going rate for schools of our type. And they don't sit in meetings, most of them, some do and get caught, get in trouble. But most don't sit up in meetings and twist their mustaches and figure out to do this. They just go and look at the net price of their aspirational institutions, the schools they want to be like, and the ones that they're competing with, and say, all right, well, we got to be somewhere in this range to be competitive with these schools. So they end up colluding de facto on the price. And so even though there's fewer people available to go to college today, because the generation of students that are ready for college today are far fewer in number because their parents had fewer children. And it's not going to change until around 2036, by the way. We're not going to see a rebound in the population until around 2036, if at all. Right? So there's fewer people to go to college. That should drive the price down in a normal market situation. But because it's an inflated false market that's propped up by the federal direct lending program, prices keep going up. It's inflating. It's costing more and more to get a degree instead of less and less. And that is not sustainable. Red pill. I'm giving you the red pill. It's not sustainable. Mark the tape. It's now 7:02 p.m. Eastern Standard Time. Okay? On Sunday the 16th? What is today? 17th. Sunday 17th. Okay? Sunday, April 17th, 2022. 7:02 p.m. Mark the tape. Come back to this episode when, not if, when the student loan bubble pops and the market goes into a major crash. Because this is not sustainable. Let's go back to it.
Tendency to burst, and this one did. People just couldn't pay for their incredibly expensive houses or keep up with their ballooning mortgage payments. Borrowers started defaulting, which put more houses back on the market for sale. But there weren't buyers, so supply was up, demand was down, and home prices started collapsing. As prices fell, some borrowers suddenly had a mortgage for way more than their home was currently worth. Some stopped paying. That led to more defaults, pushing housing prices down further. As this was happening, the big financial institutions stopped buying subprime mortgages, and subprime lenders were getting stuck with bad loans. By 2007, some really big lenders had declared bankruptcy. The problem spread to the big investors who'd poured money into these mortgage-backed securities and CDOs, and they started losing money on their investments. A bunch of money. But wait, there's more. There was another financial instrument that financial institutions had on their books that exacerbated all of these problems. Unregulated over-the-counter derivatives, including something called credit default swaps that were basically sold as insurance against the default of mortgage-backed securities. Does AIG ring a bell? It sold tens of billions of dollars worth of these insurance policies without money to back them up when things went wrong. And as we mentioned, things went terribly wrong. These credit default swaps were also turned into other securities that essentially allowed traders to bet huge amounts of money on whether the values of mortgage securities would go up or down. All these bets, these financial instruments resulted in an incredibly complicated web of assets, liabilities, and risks, so that when things started going bad, they went bad for the entire financial system. Thanks, Thought Bubble. Some major financial players declared bankruptcy, like Lehman Brothers. Others were forced into mergers or needed to be bailed out by the government. No one knew exactly how bad the balance sheets at some of these financial institutions really were. These complicated, unregulated assets made it hard to tell. Panic set in. Trading and the credit markets froze. The stock market crashed. And the U.S. economy suddenly found itself in a disastrous recession.
So what did the government do? Well, it did a lot. The Federal Reserve stepped in and offered to make emergency loans to banks. The idea was to prevent fundamentally sound banks from collapsing just because their lenders were panicking. The government enacted a program called TARP, the Troubled Assets Relief Program, which the rest of us call the bank bailout. This initially earmarked $700 billion to shore up the banks. It actually ended up spending $250 billion bailing out the banks and was later expanded to help automakers, AIG, and homeowners. In combination with lending by the Fed, this helped stop the cascade of panic in the financial system. Treasury also conducted stress tests on the largest Wall Street banks. Government accountants swarmed over bank balance sheets and publicly announced which ones were sound and which ones needed to raise more money. This eliminated some of the uncertainty that had paralyzed lending among institutions. Congress also passed a huge stimulus package in January 2009. This pumped over $800 billion into the economy through new spending and tax cuts. This helped slow the free fall of spending, output, and employment.
In 2010, Congress passed a financial reform called the Dodd-Frank Law. It took steps to increase transparency and to prevent banks from taking on so much risk. Dodd-Frank did a lot of things. It set up a consumer protection bureau to reduce predatory lending. It required that financial derivatives be traded in exchanges that all market participants can observe. And it put mechanisms in place for large banks to fail in a controlled, predictable manner. But there's no consensus on whether this regulation is enough to prevent future crises.
So what have we learned from all this? Well, one key factor that led to the 2008 financial crisis was perverse incentives. A perverse incentive is when a policy ends up having a negative effect opposite of what was intended. Like mortgage brokers got bonuses for lending out more money, but that encouraged them to make risky loans, which hurt profits in the end. That leads us to moral hazard. This is when one person takes on more risk because someone else bears the burden of that risk. Banks and lenders were willing to lend to subprime borrowers because they planned to sell the mortgages to somebody else. Everyone thought they could pass the risk up the line. The phrase "too big to fail" is a perfect example of moral hazard. If banks know that they're going to be bailed out by the government, they have an incentive to make risky or perhaps unwise bets. Former Fed Chairman Alan Greenspan summed it up really nicely when he said, if they're too big to fail, they're too big.
When something terrible happens, people naturally look for someone to blame. In the case of the 2008 financial crisis, no one had to look very far because the blame and the pain was spread throughout the U.S. economy. The government failed to regulate and supervise the financial system. To quote the Bipartisan Financial Crisis Inquiry Commission report, the sentries were not at their post, in no small part due to the widely accepted faith in the self-correcting nature of the markets and the ability of financial institutions to effectively police. themselves. The report placed some of the blame on the years of deregulation in the financial industry and blamed regulators themselves for not doing more. The financial industry failed. Everyone in the system was borrowing too much money and taking too much risk, from the big financial institutions to individual borrowers. The institutions were taking on huge debt loads to invest in risky assets, and huge number of homeowners were taking on mortgages they couldn't afford. But the thing to remember about this massive systemic failure is that it happened in a system made up of humans, with human failings. Some didn't understand what was happening. Some willfully ignored the problems, and some were simply unethical, motivated by the massive amounts of money involved. I think we should give the last word today to the Financial Crisis Inquiry Commission report. To paraphrase Shakespeare, they wrote, "The fault lies not in the stars, but in us." Thanks for